Around 2.2 million Australians own an investment property.
Over 1.1 million of them claim a rental loss every single year. The rule that makes the maths work is called negative gearing.
And in May 2026, the government announced the biggest change to it in nearly 30 years. Let us break it down.
Let us start with what most people get wrong about negative gearing.
Most people think it is a magic tax loophole. It is not. Others think it is only for the wealthy.
But ATO data shows nearly 70% of negatively geared property owners earn under $80,000 a year. It is a basic tax rule that anyone can use.
Here is the actual definition.
Negative gearing happens when the cost of owning an investment is greater than the income that investment produces. In property terms, your interest, rates, insurance, and management fees are higher than the rent you collect.
The shortfall is a loss. And in Australia, that loss can be deducted against your salary at tax time.
Let us follow the actual flow of money.
Step 1. The tenant pays rent into your account. Step 2. The bank, council, insurer and property manager take their cut. If expenses are higher than rent, you have a rental loss.
Step 3. At tax time the ATO lets you subtract that loss from your salary. Lower taxable income means a tax refund.
Let us look at some real numbers.
James earns $100,000 per year and owns a $500,000 apartment in Brisbane. Annual rent $24,000. Annual expenses including interest $42,000.
That is a rental loss of $18,000. At his marginal tax rate of 34% including Medicare, the ATO refunds him about $6,100.
Here is why critics call negative gearing regressive.
Take the same $10,000 rental loss. An investor on the 34% bracket saves $3,400. Same loss, same property.
An investor on the 47% bracket saves $4,700 from the same loss. The benefit scales with the tax bracket.
So why do banks and investors love negative gearing?
Banks love it because it justifies a much bigger loan secured against your salary. Investors accept short-term cash losses because they bet on long-term capital growth.
And between 1999 and 2026, Australian housing prices grew 407%. That is the bet investors have been winning for nearly 3 decades.
3 rules decide whether negative gearing actually works for you.
Rule 1. Only deductible expenses count. Loan interest is deductible. Loan principal is not. Stamp duty is not.
Rule 2. Depreciation is a non-cash deduction. A property can be tax negative, but cash positive. Rule 3. Capital growth has to outpace your cumulative cash loss. No growth, no strategy.
Now let us extend the maths over 10 years.
After the tax refund, James loses about $11,000 in cash per year. Over 10 years that is $110,000 out of pocket.
But if the property grows at 5% per year, it is worth $814,000 in year 10. The capital gain covers the losses. Negative gearing is a bet on growth showing up.
The 2026 federal budget changed all of this.
3 dates matter. The 12th of May, 2026 at 7:30 p.m. Properties bought before this time keep current rules forever. The 30th of June, 2027, last day of the current system.
The 1st of July, 2027, established properties bought after the cutoff lose the ability to offset rental losses against salary. The losses get quarantined.
There is one big exemption.
New build properties keep full negative gearing access. The government wants investor money funding new housing supply, not bidding up existing stock.
Existing investors are grandfathered. If you own before 7:30 p.m. on the 12th of May, 2026, nothing changes on that property. The new versus established distinction now drives every investor decision.
5 mistakes that cost investors thousands.
1. Buying for the tax refund instead of for capital growth. The refund is never bigger than the cash loss. 2. Forgetting that depreciation reduces your cost base and increases capital gains tax when you sell.
3. Ignoring the new 2026 rules and buying an established property assuming the current system continues. From the 1st of July, 2027 for new purchases, it will not.
Let us bring it all together.
You understand the real mechanics. You know the tax saving scales with your marginal rate. And you know the 3 dates from the 2026 budget that change everything.
You now know more about negative gearing than 90% of property investors.
Thanks for watching. This is general information only, not personal financial advice.
Subscribe to Smart Money Decisions.
See you there.